Hey everyone, welcome back to Corporate Decoder. Today, we're diving into Innventure's latest filing with the SEC. Let's just say it's a bit like a choose-your-own-adventure book, but instead of fighting dragons, we're deciphering financial statements. Fasten your seatbelts because it's going to be a bumpy ride. Here's the gist of it: Innventure, which focuses on launching and funding sustainable tech companies, just filed an update that includes audited financials. They have a plan to build billion-dollar companies, but as usual, the story is in the details, with a few twists about their debt and a note about their ability to keep going. First up, this is Post-Effective Amendment No. 1, which means it's an update to a previous filing. So it has updated information on their business financial condition, including audited financial statements as of the end of last year. Also, it gives more details about the stockholders, including any sales or other changes in who owns the stock. Now, before we get too excited, let's face the music. Innventure's business comes with a whole symphony of risks. A big one? They might not be able to get more money to keep things running and growing. There's also this little note about whether they can maintain enough cash to operate effectively, which frankly raises substantial doubt about their ability to continue as a going concern. Not exactly the words you want to see. It also mentions a few Innventure companies that are in early commercial stage that may never achieve or sustain profitability. Oh, and they rely on people to license or acquire technology. So if they can't find technology providers, they're in trouble. As always, you can't forget general economic downturns and high interest rates, all of which impact their business. Alright, let's get into the numbers. Because they changed accounting as a result of the business combination, the report splits the numbers into two periods, before and after the change, which they label predecessor and successor. We will focus on the S-team combined, which combine results of the predecessor and successor periods for a 12-month total. The report says that these numbers are not considered to be prepared in accordance with US GAAP, so take these as management's non-official way of looking at the numbers. Total revenue was about $1.2 million compared to $1 million the year before, a small increase around 9%. They say it's from new product sales in their technology segment, but it's partly offset by losing some consulting revenue. Now, the interesting part, general and administrative expenses shot up by almost 220%. That's $56 million compared to $17.6 million, primarily because of higher professional and legal fees related to the business combination, plus increased bonuses and stock-based compensation. They actually made $11.5 million on their investments compared to losing money the previous year. They attribute this to the unrealized gain on pure cycle stock. The losses belonging to smaller, non-controlling owners increased greatly from 2023 to 2024, from a $139,000 loss to an over $20 million loss. That tells us losses within Accession are growing quite a bit. Moving on to cash flow, Innventure used a lot more cash in their operations, a jump of almost 150%. That's a cash outflow of $48 million compared to about $19 million the year prior. They point the finger at higher costs related to the business combination and increased compensation plus research and development. Speaking of cash, the good news is they have around $11 million in cash and equivalents, up from $2.5 million. The bad news is their working capital is deeply in the red, a negative $45 million. This section says that based on their current expectations, they estimate needing at least $50 million to meet their liquidity requirements for the next 12 months. They hope to solve the needs through operations and other sales. Speaking of liquidity, it's worth noting that Innventure took out some bridge financing from related parties, including CEO Michael O'Twerth. These were short-term loans to keep things afloat, and later they were settled by issuing new Series C preferred stock. A little bit of financial engineering, but maybe it kept the lights on. Here's where things get a little more serious. The company admits to having material weaknesses in their internal controls for financial reporting. If they don't fix this, it could result in material misstatements in its financial statements, which could shake investor confidence and send the stock price tumbling. The A&R Certificate of Incorporation isn't all sunshine and daisies. It contains provisions that could significantly reduce the value of the common stock. As a company increasingly reliant on digital operations, Innventure faces the growing threat of cyber attacks. A successful material cyber attack may result in the loss or compromise of customer financial or operational data. Time for a quick rundown on who's steering this ship. The board consists of Gregory Haskell as CEO and Daniel Hennessy, a director designated by LearnCW, and some other great people. They are all split up as Class I, R, and the Third. But what is the difference? Well, a classified board is a big part of the report we are decoding. It's not just a seating arrangement. The classified board structure, where directors serve staggered terms, makes it harder for a potential acquirer to quickly take control. A staggered board can discourage hostile takeovers since it takes multiple election cycles to replace a majority of the board. This can protect management and their strategies, but it may also limit shareholders' ability to enact change if they disagree with the company's direction. This means that even if someone buys up a ton of Innventure shares, they can't immediately replace the board. So this could be a bit of a hurdle for outside investors looking to shake things up. Another interesting table that has been included in the report is about executive compensation. It can often tell us a lot about the true focus of the management and how they get compensated. If someone gets compensated on revenue, it means they care a lot about increasing that. If they get compensation for some milestone, they might be rushing for that with long-term results. So what's my take on all this? Innventure has a vision, but I will be honest, the financials show a company still grappling with the costs of growth and the complexities of its structure. While their revenue grew, the expenses have grown at a multiple. I think the biggest concerns surround their debt and ability to raise capital, and those going concern warnings are worth paying close attention to. Innventure needs to show they can turn potential into profit, scale their businesses, and not only find the breakthrough tech from partners, but that they actually commercialize into products that customers want at scale. Innventure is a high-risk, high-reward play. Buckle up. What do you think about Innventure? Is it a buy, sell, or hold? Let me know in the comments, and don't forget to like and subscribe for more corporate deep dives.